today's video, I want to give you a deep dive into the world of real estate and how you can buy your first property. I'll be breaking down the numbers, explaining the jargon, and give you a roadmap how you can navigate the journey towards home ownership. And it doesn't matter if you buy it to live yourself in the home or whether you use it as an investment property to boost your income. Of course, there are also other ways how you can invest into real estate through real estate investment trusts, for example, which are basically stocks into a company, and that company buys on your behalf various real estate across the country, across the world. And that's something I do as well. Over time, the stock hopefully appreciates. Plus, they pay me a monthly dividend, almost similar like a monthly rent. So that's a great way as well. But today, I really want to talk about owning physical real estate that you physically own, because I really believe that real estate can be one of the best investments in the long term. Actually, for myself, it's true as well, because I've done a lot of investments into cryptocurrency, stocks, dividend growth stocks. But actually, my real estate that I bought in Dubai was so far my best investment. That's why I'm really passionate about it. I understand it can take a lot of money to start with, but actually, if you're smart with your money, using leverage, using a bank's money to obviously start owning your real estate and build up the equity, the part of the real estate that you own, and by actually doing that, be much better off than people who are renting and paying the money to another landlord every single month. In the end of the video, I'm also going to give you a few ideas as to why I think owning and investing into your own real estate can be a much better option than paying rent. Without further ado, let's get started. Alright, so let's look at some of the financials of an average house that you can buy. And really, it doesn't matter where you buy it, but obviously I base myself in Europe because I'm based in Europe, but obviously I understand it depends on country to country. You know, some of the values are different, some of the interest rates are different, but just overall, to get an idea, if you're a first-time home buyer, what are the kind of costs that you're looking at and how is the mortgage being derived? So let's start off with the property price, right? And it doesn't matter if you buy an apartment, a house, depending where you live, sometimes an apartment more expensive, sometimes a house more expensive. It's funny, in the place where I live in Vilnius, Lithuania, actually apartments in city center cost more than a big house outside of the city center. So it's interesting. Other places, if you buy a big house, it costs actually more than an apartment. So once again, it depends on different cities. But for the sake of the exercise, let's just take an overall example. You buy a property. Again, it doesn't matter what kind of property, but whatever you want. And let's consider $500,000 as a going price, right? If you buy it in any capital in Europe, that's probably kind of the price for average place. It's not even something fancy. I mean, for $500,000 in Vilnius, you actually don't find many super nice places anymore because they're really going upwards towards $1 million. When I came here 7 years ago, for $500,000, you could really find something amazing. So I regret this quite a bit that I didn't buy here in time, but that's the beauty of real estate. Over time, if you're buying great locations, the price only goes one way and that's up. Surely there are fluctuations along the way, but generally prices go up. That's why I'm so excited about real estate. So then obviously you go to the bank because you probably don't have $500,000 lying around in your bank account. If you did, you probably wouldn't be watching my videos, instead rather drive in your Lamborghini. So most likely most of us would take some kind of mortgage to buy a property. And it actually also makes financial sense because once again, you're using leverage, other people's money. So in this case, if you want to take a mortgage, basically a loan is a fancy word for a loan, the same way how we take a loan to buy a car from the bank. If you take a loan to buy a house, it's called a mortgage. And usually, once again, it really depends on the places where you live. Some places I heard the bank asks you for as little as 5% in the States. That's quite common. But most other places can be anywhere from 10, 15 to 20. So let's go on the high side to 20%, especially now that interest rates are going up. Actually, the banks also ask for a more guarantee from the borrower because there's a higher likelihood that people might default on their mortgage. So they want to have more sort of insurance that the person taking the loan actually has the funds to repay it. So let's assume 20% of $500,000 is 100,000. So that's something you would need to have already saved up. It can be in one account, can be different accounts. But at some stage, if the bank pays you the loan, you obviously need to show that you have those funds and obviously, have them available. So that obviously then brings the loan amount to 400,000. So that's the amount that the bank will borrow you and obviously also charge you interest on. So let's talk about the mortgage rate, or interest rate as it most commonly referred to. That obviously depends in case you live in Europe, the Euribor. This is basically the bank at which other banks are borrowing money from the central bank. So if that goes up, then the other banks, usually they put a margin on top. So if the Euribor rate is at 3%, other banks might put 1%, 2%, 3% on top of it. So it kind of floats with the Euribor rate. We see the same over in the US. That's why they always say when the Fed increased the rates, basically borrowing gets more expensive. On the other hand, those people who are saving, when you save your money in the bank, hopefully you're also getting more bang for your buck. Banks actually start paying you interest for having your money. So that's nice to see. But if you borrow, obviously it gets more expensive. So for the sake of this exercise, I took 5.5%, which in some countries is still on the lower side. I've heard some people borrowing at 7%, which is really extremely high in my opinion. But let's not forget that not so long ago, even Lithuania and other parts of Europe, you could borrow for 1.5% or 2%, which is really, really good when you think about the amount of money you're borrowing and the little percentage to pay back. So obviously that's not set in stone. There are ways to fix interest rates, but right now with the high interest rates we're having, probably wouldn't be the smartest way to fix that. Those who fixed it before at 2% or less, they really benefit from it. But others, usually have a floating rate for 12 months, what have you. So for the sake of this exercise, let's go with 5.5% interest. And then of course, what we need to look at is the loan. How long you want to take the loan for and what is the period until you repay the entire mortgage or loan amount. So usually most people go with either 20 years or 30 years. Now, what's the difference, you may ask? The shorter, the less interest you pay over time. The longer the mortgage, the higher the amount of total interest is that you're going to have to repay. On the flip side though, if you have a longer term, the monthly amount will be less. So if you're a little bit tight for cash, or you might think that the interest will go up and then you might have spending more than you actually earn, then obviously it would make sense to extend the term. If you're really confident that you will, out earn your mortgage payment by 4 times or 5 times, then definitely it might make sense to reduce the term, because that way the total interest, because it's also a shorter period, will be less, so would be more beneficial to you. So it really depends on your life circumstances. In my case, if I was to take a mortgage right now, I would probably go with 30 years. Right, and with these parameters, basically, you easily can calculate your monthly mortgage payment, which in this case would be 2,267 euros to the bank, right? So once again, with these couple of parameters, you can really easily calculate your monthly fee. So if I would change one of those parameters, the monthly fee would change accordingly. And that's what's a good way to understand how much real estate you can afford, right? If, for example, you're earning 2,500 euros and let's say you're a single person looking to buy their first apartment, then obviously that calculation and that amount of real estate at the current rate would be out of reach, because you wouldn't want to live on 300 euros a month, right? So in this case, either reduce your property price or obviously be able to increase your down payment. That's also an option. If you can maybe provide 14%, maybe you inherited some money and then you have to borrow less money, and that way also your monthly mortgage rate will be less. Or of course you find a better mortgage rate, but that's very difficult because usually they're all within a similar range. And unfortunately, loan term, you can't really extend beyond 30 years. Most banks will give a maximum of 30 years. So it's not something you can do over 60 years because that would be too risky for banks. So in that case, usually it's 30 years maximum. So yeah, if that's still too high for you, then well, it's unfortunately, in this case, either you wait until you have a higher monthly income, or obviously you look for a smaller property with a lower price so that you can actually easily manage to afford your monthly mortgage. Right, but let's have a look how important the interest rate is. Because let's take the same example, the same property price, the same down payment for 30 years, but the only difference here is the mortgage rate. So instead of 5.5%, it will be 3%. So lower, and hopefully will go down soon, because right now I really think we peaked soon, and hopefully central banks start lowering the rate soon again, because I think it's not sustainable to have them so high. Less people will be able to afford real estate. So I think over time it's going to come down. So if it would drop from 5.5% to 3%, already you can see the monthly mortgage payment drop by almost 600 euros from 2.2 to only 1.68K per month. So that's definitely a nice improvement over there. And if we look at the third example, as I mentioned before, some people actually not so long ago managed to get interest rates at 2%, even below. So let's take 2% in this example, which honestly wouldn't surprise me if we go back to this in the near future. So if we were to go back to 2%, your monthly payment would now be less than 1,500. So you can see a huge difference in the swing and the importance of interest rates. So if it went down to this, obviously it would make sense to refinance in case you locked it up before, and then obviously try to fix the lowest interest rate possible for as long as possible. So in case it goes up again, you don't have a floating interest rate, but you fix it. I think at 2% you can definitely afford to fix it for as long as you possibly can. And that way you will be saving quite a bit of money every single month. I mean, imagine the difference between 1.4 versus 2.2. So it's quite a big difference. And obviously that will either be your cash flow, positive cash flow, or negative cash flow. So I think it's super important to look at the interest rate. And that's why I know right now for a lot of people, with the interest rate being so high, they just can't afford. When they run the numbers, they see the monthly payment too high. So I understand that. So that's why I said, look at finding a bargain where you look at the real estate price of the property you're buying, because what you don't want to do is that you do close with the monthly mortgage amount to your income. Because if something goes wrong, or that number goes up, or you're being laid off, which can happen as well, right? And you run into difficulties, you might be very easily losing your entire property, which is not worth it, right? So I think always keep a margin of safety here and be very conservative when you run such numbers. Before we move on, I do have a little gift for you, and that's my monthly budget planner and net worth tracker. Because I always think if you don't measure it, you can't manage it. So I think it's really important to look at your budget on a monthly basis and then track your net worth, right? All your assets minus your liabilities and see how much you're worth, and hopefully that amount grows over time. So if you don't track it, it's hard to know if it's going up or going down. So I think it's super important, and if you want to get it, then use the link in the description below, sign up to my newsletter, and you'll be getting access to the file you can download and start using it. So feel free to check it out. Hope you're gonna like it. Now, a couple of other things to consider when you do purchase a property, and these are the following, and that's related to property taxes. Now, once again, it depends on the country you're in. It's really hard to generalize, but generally on a 500,000 euro property, you can expect to pay around 1,000 euros per year, that is, in property taxes. Once again, it really depends on which country, where you live, etc. But on average, 1,000 euro could be a ballpark figure to keep in mind that it is on top of your monthly mortgage payments. Then, of course, there's home insurance you might be needing. Some countries, they stipulate that you need to have it. Other countries, it is optional. But of course, you may really want to invest into it because, God forbid, something happens, the house burns down, or there's some kind of storm and things happen to your house. Whatever, especially when you live in an apartment, right? It may not be your fault. Somebody else has an issue with their apartment. They doesn't have insurance. Your apartment, as a consequence, maybe from a leakage from a neighbor on top of you, is being damaged. Or once again, the entire building burns down and the builder doesn't have an insurance. You want to have your own insurance just to be on the safe side. So once again, let's be very conservative here. And with 500 euros a year, you should be covered for most of these things. Of course, you can have a more expensive one or a cheaper one, but on average, more or less, I think that's a fairly reasonable amount to put for yearly insurance to have for your home. Then most likely also going to have notary fees. Once again, they're going to differ country to country, and that's a one-off. So that's not a monthly or annual amount. That's whenever you buy the property to notarize and kind of authorize and legally sign all these documents. Usually you need to have a notary. Again, in some countries that might be 1,000, other countries might be 10,000. So that's just an estimate that I found out, but that's a once-off, and afterwards you're never going to have to pay this again. And of course, you need the provision for buying FF&E, fixtures, furnitures, and equipment. Now, that obviously depends if you're moving your existing furniture that you might have in your current place into the new place, or maybe you buy a place that's already fully furnished. So it's once again something that might be an expense, and if it is, you should consider it. And for example, with 20,000, I think you get a long way to buy at least the basics, your couch, your cupboards, your kitchen, etc. But if you want something very fancy, it might be easily 50,000. I know people who spend easily 2,000 euros per square meter. So if you live in a 100 square meter apartment, that will be 200,000 on top of it. So it's really hard to know what is the amount, but roughly, I think with the basics, if you buy an empty apartment, that's something, once again, a one-off that you want to keep in mind that will be on top of your previous expense. And lastly, we have the homeowners association fees. Now, that once again depends where you live. If you have your own house somewhere in the countryside, outside, you live by yourself, most likely you're not going to be having that. But some people buy a house in a gated community, etc. So there's going to be an owners association, and you have to pay, a monthly fee to maintain the public areas. Obviously, you pay for security in case it's applicable. Or if you look at apartments, the same is quite commonly as well. When you do have some of the more modern apartments, you might have a concierge downstairs or people taking care of the garbage, etc., cleaning the public staircase, etc. So there, usually you pay 2-3 euros per square meter per month. And that's something you have to factor in, and that's being paid every single month. But let's say on average in a year, you will be paying around 600 euros, which I think is quite common. So that's another expense to keep in mind. Of course, on top of this, I didn't mention the utilities, but that's something you would anyways pay if you're renting or you're owning, right? All the heat, water, gas, electricity. So that's really hard to estimate because it really depends on how many family members you are, where you live, in an apartment, in a house, which country. So that's really tough to average out. But I think looking at those costs, these are the main things that you need to consider when you run your own numbers and see how much real estate you can actually afford with your current income. So actually a pretty straightforward calculation, but what I also want to mention here is some of the benefits of owning real estate versus renting. And the first one has to do with building equity. Every month that you pay off your mortgage, I know it feels painful, you're going to pay for 30 years potentially, and you think, oh my God, what's happening? It feels like paying rent, what's the difference? But actually, of course, some of the money goes towards paying the interest, so a portion of the monthly mortgage is going towards the interest, but another portion is going into equity. That means you every month own a little bit more of that house. So in the beginning, when you look at the whole house, you only own a certain part, basically 20%, because that's the down payment. The rest, technically still belongs to the bank because they only borrowed it to you. So with every month, you're actually buying more piece of the house, right? It's like buying shares in a company. With every time you buy more share, you own more of that company. And the same is true with the house and real estate investing. So every month, the bank owns less of the house and you own more. So that's really a nice way how you build up your equity. And in a way, it's like forced saving, right? You put money aside, but that money actually goes into the equity. And at the same time, that equity may be worth more over time. And that's a great benefit of owning versus renting. Because with renting, you pay that for 2, 3, 5, 10 years. And in the end, you still own just as much as you did on the first day, which is 0% of the property that you rented. The second benefit is a potential appreciation of your real estate price. Now, as I said, nothing is ever guaranteed. It doesn't mean you buy real estate and it's guaranteed to go up. But if you buy it in a good city, in a good location, more likely than not, it is going to appreciate over time. Now, certain periods in an economy, there might be a recession, etc., where markets drop. But as I said, over time, 20, 30, 40-year period, most of real estate markets over time actually outperformed many markets, stocks, and other investment classes. And that's really proven time track record. So if you buy in a good place, a good property with good value, so with every month that you pay a mortgage and start owning more equity, more of your own property, so these shares are actually also worth more if one day you're going to be selling it. And of course, you can sell your property before the 30 years, right? A lot of people, they sell it after 10, 15 years when already the property increased in value. They sell it at a higher price, repay the bank the amount that was outstanding, and then pocket the difference, and then they can upgrade to a bigger house. So that's a very common way how people, improve their living standards, so to say. So there's a high likelihood that your investment into your house actually goes up. Once again, if you rent, there's no opportunity for that because basically you don't own anything in that. And the only thing that could go up might be your rent. So here you're really on the better side, owning rather than renting. Another big benefit refers to taxation because in a lot of countries, you can actually write off some of the costs that you have, such as interest payments on your mortgage against your income tax. So you can deduct that amount and basically pay less income tax and therefore end up with more money in your pocket at the end of the month rather than if you would have rented, which is something you cannot write off your tax. So depends where you live, you can really get some great tax advantage by investing into your own house rather than paying rent because that wouldn't give any tax advantages to you. So run the numbers, see where you live and see how much benefits you can get. But really, it can make a huge difference, especially once again, now that interest rates are so high, the amount is going to be quite large. And that can actually help you at the end of the year to still have a higher income despite high interest payments. So that can be really worthwhile. Another big benefit of people who own their own real estate, it gives you a sense of stability, right? There's no landlord that is overshadowing you and that might potentially increase the rent from one year to the other. You're always at the risk of them. You never know what they want, or they might give you a hard time because you bought a pet and they're not pet friendly. So you're always at the mercy of the landlord. And at the same time, having your own four walls, it's just something about it. It's your own little kingdom, right? You can really feel free. Whatever happens in the world, you lose your job, what have you. Let's say your place is paid off. You have no more payments in the future one day. And you live free basically, right? You only pay for electricity or water, whatever you have, but the rest, more or less, it's yours. There's no monthly payment, there's no pressure to be able to afford the rent, etc. So many people struggle with paying their next monthly rent. So if you have your own four walls, it definitely gives you a sense of security and comfort. So that can be a huge benefit as well in the long run. Another advantage is the fact that it might also be potentially cheaper than renting. Now, of course, you would need to run your own numbers, but if you manage to secure at a low interest rate, then honestly, some of the rents in the city center where you stay might actually be more expensive than your monthly mortgage payment. And that's actually how people really start to grow their real estate empire, so to say, because what they do is they find the down payment, obviously it's something you need to save up, and then they purchase their own property, they mortgage it, and they make sure that the mortgage is less than the rent they would pay or somebody else would pay. So in this case, you could rent it out to somebody. They pay you, let's say, 2,000 euros in rent. Your monthly mortgage is 1,500. So they basically, the renters who are renting in your place, paying off your property that you own more of every single month, while at the same time, you pocket a cash flow difference of 500 euros every single month that you can then reinvest into your next property, right? So that's how you start compounding your real estate growth. And that's the beauty of it. And now a lot of rich people in real estate got richer over time by making sure they have a positive cash flow on their property, so that basically what you get in income is higher than your outgoings, your mortgage payment in this case. And honestly, it's not really impossible. Of course, right now where the interest rates are higher, it's a little bit more difficult. So even if right now the rent is the same as your monthly mortgage, at least that's being paid off. And then as the interest rates hopefully over time comes down, you start pocketing the difference, and rent usually only goes one way, and that's up. So over time, that difference will increase. And then once again, you can use those funds to save up for your next down payment and then start buying your next property. And there you have it, guys. I hope you found this useful. I really strongly recommend considering investing into real estate. Now, I understand if you just graduated or you're starting your first job, obviously it's a little bit difficult to come up with a big down payment. That's a limiting factor for a lot of people, to come up with that initial down payment, which once again, depending where you live, can be 20 or even 25%. So that can be a substantial amount. So that could be something for you to really save for, put money aside. Maybe instead of investing into meme stocks, if you're really serious about real estate investing, put the money aside. Right now, you can actually get good interest for it. So put it into an interest-bearing account. I do the same. For that, I use Trade Republic or Lightyear, and you can use my link in the description below and get some free shares to get you started. And then you're actually going to get paid daily interest, paid to you out on a monthly basis, and you can start making money on your money. And once you saved up enough money for that, obviously you go to the bank, you take out a mortgage, and you start your real estate investment journey. Now, once again, looking at my Dubai apartment has been one of my best investments so far. And if you want to find out more about it, you can check out this video over here. And personally, I'm super excited about real estate, and my plan is to add more properties in the future. And if you want to follow me on the journey and never miss a video, then please hit the subscribe button, give the video a like, then I know I'm going to be making more of those videos in the future. As always, guys, thank you so much for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.